Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Greg King, founder and CEO of RexShares. We take a closer look at one of the most important topics in the fund world that investors struggle with, and that is volatility. We go over how the segment's main benchmark is constructed, the ins and outs of the world of volatility, and how weekly futures might offer investors new opportunities in this market. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Greg right after this. Okay, Greg, thanks for joining us to talk about a topic that most investors have heard of, but might not completely understand, and that is volatility. And when most investors think of volatility, they're probably referring to the CBOE Volatility Index, better known as the VIX. So how is this benchmark constructed?
Sure. The construction of the VIX index is pretty complicated if you delve into the underlying math. But the basic idea is that it's trying to measure the expected volatility of the S&P 500 index over the next 30 days. And to actually do that, it samples a set of options, puts and calls, and reverses out the implied volatility, which you may remember from your options class is basically one of the Greeks embedded in options pricing. So that number put together across all those different options is what constitutes the VIX index.
So why is it called the fear index? Is a high VIX a signal for bearishness, and likewise for bulls when the VIX is low?
Yeah, that's a great question. This really goes back to how the VIX behaves. And to understand that, I guess you need to understand that markets inherently, generally speaking, normal conditions, crash down. They don't really crash up, right? They sort of slowly climb, and then something happens, they might crash down. And so you have this idea that there's more volatility to the downside. So generally, the VIX will perform in an inverse way with the S&P 500. So S&P 500 has a very bad day. VIX is likely to be up. And I think that's what goes to this concept that it's the fear index. People gravitate towards it, which basically means they're gravitating towards options and probably puts when things are really coming off the rails.
So if I see that the VIX rose from, say 15 to 20, what does that mean for the average investor out there?
For the average investor, I'm not sure it means a whole lot. What it means in terms of option pricing and just general market sentiment is the market is charging a little bit higher premium for protection on the S&P 500 over the next 30 days. So generally, all things being equal, the market is telling you, hey, we're expecting a little bit more volatility. Instead of something around 15% volatility over the next 30 days, we're expecting something like 20. Now, that may or may not happen. You got to remember that this is what's called implied volatility. So it's the pricing that's embedded in the options. Realized volatility, what actually happens over that time period, will be something different. Could be more, could be less.
So there's no way to invest in the VIX directly. So the futures market has kind of developed to make this investable. What are some of the pros and cons of using futures in order to try and track this underlying VIX index?
You're right. The futures are the main way that people get exposure to the VIX index in terms of making a quote-unquote investment in it. And they do so via different exchange-traded products typically or directly through the futures. The thing about a future, of course, is that it is a contract to buy something in the future. So now you have a future exposure to the movements of VIX, or where will VIX be in the future, a month in the future or 2 months in the future. And the answer to that is it's likely to be somewhere different than today. And generally speaking, the price is a little bit higher out into the future than it is today. And so what that means as far as futures investing is that you have an upward sloping curve. And if you think about other futures curves, like you might have in oil, for example, that can give rise to a loss as you roll the contract if the curve is in contango. So I know I'm kind of throwing a lot of terms there, but upward sloping is just referred to as contango. Downward sloping is referred to as backwardation. And with long VIX exposure via futures contracts, typically the farther out a contract is, the more expensive it is. And so as that nears expiry nears the current time frame, that value deteriorates, and then you have to go and buy and roll it into the next month and the next month.
And each time people are rolling, they're doing so at this higher level. So that kind of creates this roll yield hurdle, if you will. And is that primary the reason why a lot of these futures-based securities in the volatility world have this kind of really horrendous long-term performance if you look at it, over years, because, volatility is traditionally in contango. Is that correct?
That is right. But if you take a step back and just remember, what are you doing here? You're getting long volatility. And what volatility is, as we discussed, this kind of metric of what's the implied movement going to be in the S&P over the next 30 days. Well, it's unlikely to go to zero, right? Not too many people are going to price options with a zero vol. And when you're at low levels, let's say like we are now in 11 or 12, it's not, in fact, historically has never really gotten priced below, I think, 9 and change. So you have an asymmetric return profile. Volatility has, on the other hand, gone up to 30, 40, 60, even 80 in times of the crisis. So if you think about a risk-reward type scenario, who wouldn't want to be in a product that had only a couple of points to the downside and then dozens and scores of points to the upside? That's not telling the whole story, though. Because of the futures cost, there's a cost to sitting in that position. And if you think about it, if there weren't, it would be somewhat of a free lunch. If you think about it another way, options, as there are many studies out there in terms of the percentage of options that expire, worthless, right? So randomly buying options in, I don't know what it is, maybe around 80% of the cases, maybe 90, is just paying premium that is going to expire worthless, right? And so getting long volatility by a random option buying strategy would result in, very large losses on a random basis. So broadly speaking, just getting long volatility in the S&P 500 across 500 stocks at the current levels at any given time is going to have a daily cost to it, and that's a time decay. So if you look at it from the opposite perspective, and a lot of people have done this, being short those futures tends to pay those investors for being in that position. Now, of course, it can be a dangerous position to be in when VIX is rallying and spiking, but otherwise it's generally a position that accumulates value rather than deteriorates in value.
And the opposite is also true for this scenario when futures are in backwardation. So when investors are believing that the market is going to get a lot more volatile here over the near term. So in that type of scenario, a long VIX bet would probably be the best way to go. Is that fair to say?
Yes, I have to stay away from specific recommendations, but I tell you what, when the shoe goes on the other foot and you are being paid to be long volatility with a backwardated futures market, the thing to watch out for there is essentially the market's telling you, hey, volatility is elevated right now, and in future we don't think it's going to be as high, right? So in one sense, yeah, it's making you money on a theoretical basis every day, but at some point the market's saying this is going to come back down. So the backwardation only tends to happen after a big spike. You're right about that. But then the equation basically switches, and you have to worry about when is volatility going to settle back down, because it's unlikely that the amount of positive roll yield you get from rolling the futures is going to make up for the potential loss as it settles back down to normal levels. Keep in mind the whole time, in the background, I think driving a lot of this is volatility is a mean reverting type of metric. That's why there's a big debate about whether it's an asset class. It doesn't have an inherent return. It's really just a metric. And so most people view it as mean reverting over time.
So most of the VIX products out there use monthly futures, but they're now weekly futures too. What's kind of the key difference between these two types, obviously besides the time?
The weekly, obviously, yeah, there's a time difference. I think the main, and we're still waiting for the weeklies to build up in volume and liquidity, but the main difference is, or I guess the advantage of having the weeklies is that you can get a little more bang for your buck in those types of exposures. The way that we look at it, and we have a couple ETFs that do use the weekly contracts, the VMAX and the VMIN ETFs. The idea is, okay, if you're a long investor in VIX-related exchange-traded funds, you're very likely doing that as a hedge for your portfolio. And so when people want something that hedges a large part of their portfolio, typically they're looking to put up as little capital as possible in order to provide the biggest hedge. Using the weeklies in our fund, well, we get a little bit higher beta. Actually, it's about 30% higher than just the typical monthly rolling strategy. And that allows people to use that product and be a little bit more efficient potentially with their hedging. If you look at the other exposure and say, oh, okay, I'm a short investor, why would I want to look at these weekly contracts? It tends to be a little steeper down in the less than 30 days part of the curve. And so you might potentially pick up more of a return by being short those contracts instead of the longer dated ones. That's kind of how we look at the advantages that the weekly contract brought to the market. Of course, those, some of those advantages come with potential additional risk.
What are the additional risks?
Well, it's just essentially that you've got a higher beta. So the CBOE, if you go to the CBOE website, they've got a great chart buried somewhere in there. It's also on our website. They give us permission to post it, which gives you the historical beta of all VIX futures contracts to the VIX itself. And so if you think about it logically, a contract with, let's say, 1 or 2 days to expiry is going to track the spot VIX index pretty closely, whereas a contract with, say, 2-3 months left to expiry doesn't track it so well. And there's a pretty solid relationship in terms of that beta. Generally speaking, once you get out about a month or more, you're at about a 0.5 beta to the VIX index as far as their research shows. So getting closer to spot, what we call duration, reducing the duration of your exposure through your VIX futures contracts gives you a higher beta, generally speaking, to the VIX. So essentially, whatever it is you're trying to do by trading VIX, whether it's hedging on the long side or whether it's income generation on the short side, you can do it a bit more efficiently with the weekly futures contracts potentially.
So what is the actual impact in terms of the time to expiration? I noticed that for the VMAX Long VIX Weekly Futures Strategy ETF, the VMAX, we have about 22.4 days, according to your site, for the weighted average time to expiration. Meanwhile, the S&P 500 VIX Short-Term Futures Index, it's about 33.7 weighted average time. So is this difference from this 33 to 22, is that enough to give the boost that you're referring to? Is it really this time, in between that 0 to 30 that really becomes kind of crucial for volatility investors and traders out there?
It does actually make a difference. You'd be surprised. So we just recently ran the numbers on our VMAX product versus kind of the standard benchmark, and the beta to the VIX since our product launched was about 27% higher. So in the case of the data I'm looking at, it was about 0.55 versus 0.43. And what that means is you've got less noise in what you're trying to do, and you don't have to use as much capital to do it. Now, ultimately, the weekly contracts and the monthly contracts may trade differently over time. That's the thing about futures curves, is they are kind of their own animals, and each point on the curve is almost like another joint that can be moved up and down and back and forth. So this is just what the numbers are right now. But generally, again, the CBOE's got some research that shows that these relationships tend to hold up, broadly speaking, over time. So it is material in terms of the investment performance.
Okay, yeah. It's crazy to think, just that short period of time can make such a big difference, but it sounds like that's the case. I did want to ask you about some of the structure of these products. So a lot of products out there in the VIX world, they're structured as exchange-traded notes, but you and Rex went with the ETF structure instead. What is the rationale behind that?
We had been involved actually with some of these other products when I was with Barclays and some of these other companies, and we found that there is definitely an investor base out there that cares about whether they have a fund or whether they're trading a note that has exposure to a bank. So this had not been done before. We launched a 40 Act version, which basically just means a mutual fund version of ETF that does not give off a K1. So our view was there are going to be a set of investors who care that their exposure to VIX is managed actually by a portfolio manager in a traditional fund structure. Don't get me wrong, they're still ETFs. They're just governed by the 40 Act, which means that they live under the mutual fund rules. So that was a first for the market overall. And we thought that the fund structure would be helpful. We thought that having someone at the helm who can roll these contracts and take a little discretion in terms of how they do that was, both of those were good things to bring to the market. And then also utilizing a portion of the weekly contracts to get that duration a little bit lower was also a new thing for the market as well.
So how do these products, the VMAX or the VMIN, how could you imagine this fitting into a investor's portfolio, just generally speaking? Just primarily as a hedging tool, or?
So they are, the way we look at it is they are definitely investments that have to be monitored very carefully by investors. So if someone's managing their own portfolio, they need to be, on top of these types of investments pretty much at all times. In terms of fiduciaries, they are looking at these investments as hedges when they look at the long product. But on the short product, we're seeing more and more people look at them as tactical positions. And so that means a little bit more of a buy and hold, longer term hold strategy. Our VMIN ETF is the best performing ETF across the board so far this year, because this curve in the Trump presidency has just been very, very steep. So being short that position, it's up over 44% since the year started and 90-something percent since Trump got elected in November. These types of returns attract a lot of investors to look at them, but they need to remember that if VIX spikes materially, there's going to be downdrafts in these products. But they're doing what they're supposed to, and so we see a lot of people looking at the short products as a little bit more of a tactical positioning type trade.
Okay. And do you forecast any other new volatility type products from Rex on the horizon, or are you primarily sticking with the VMAX and the VMIN for right now?
Oh, I do think we'll roll out some more products. We have nothing that has been filed right now, but we like the space. We're familiar with the space. These products have not even been out a year yet, but we definitely have a few more ideas for people, and we think that the ETF structure is going to be the right way to do these products going forward.
Okay, great. Well, best of luck with that. And Greg, thanks for coming on. I think this is a great look at a topic that confuses a lot of investors, but hopefully not so much anymore.
Thank you, Eric.
All right, everyone. That was Greg King, founder and CEO of Rex Shares. You can check out more information regarding his company's ETFs at volmaxx.com. And the symbols were VMAX for the long fund and VMIN for the short one. Additionally, the performance information was as of early March 2017. Well, hope you enjoyed this edition of the Ducharme Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Ducharme Report on iTunes, and if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDucharme, and be on the lookout for a new edition of the Ducharme Report each and every Thursday. But until then, for Zacks.com, I'm Eric Ducharme.